looking for a reversal, but how do you know that that was the last low, or how do you know that that was the last high? It can be very difficult to spot when you're looking at normal candlesticks, but it's easier to determine when that move might be finished when you're looking at footprint candlesticks. What's up, it's Thrax. We are back for our second video in our footprint chart trading series, where we go over order flow and how it can help you with your trading. In our last video, we went over the basics of footprint. What is a footprint chart? What does it look like? How you can actually read it? And what specifically a bid and ask ladder footprint candle looks like. Before I started using footprint charts, I blew account after account. I spent thousands of dollars on failed prop firm challenges and evaluations. I was taking trades with no real confirmation. I was getting faked out. I was chasing every move, and it was extremely frustrating. Thankfully, I found footprint charts, and it's helped my trading out tremendously, and I just want to share what I know about footprint charts with you guys. So in this video, we're going to be talking about a simple strategy that I use specifically for identifying when to enter in on a reversal. I'm essentially looking for signs that buyers or sellers are getting absorbed at key areas. This is where aggressive traders are hitting the market, but price just isn't moving and it's not pushing past that key area. And when I can spot that with a footprint chart, it usually tells me that a reversal might be coming. It's made a huge difference in my trading. I'm not saying it's a perfect strategy. I use my other strategy along with footprint, but it helps me with my entries on timing the right entry for a reversal. And after using this model for identifying the reversal, it's helped me avoid plenty of bad trades where in the past, looking at normal candlesticks, I probably would have taken that trade and gone stopped out. So let's get into it. All right, so here we are back on our whiteboard. And before we talk about the footprint setup for the reversal using absorption, we need to talk about what is absorption. So absorption is when large resting orders, typically from institutional players or what some people call smart money, absorb aggressive market orders without allowing price to move significantly. So it's a signal of hidden liquidity, potential reversal, or continuations depending on context. The core concept though of absorption is when aggressive buyers are hitting the ask and price doesn't move, it means that that's sell side absorption, and vice versa. If aggressive sellers are hitting the bid, but price doesn't move down, that is buy side absorption. And if you don't know what the bid and the ask is, we went over that in our last video, so it might help you understand this video a little bit more. But that's the basic concept of absorption. So what does that actually tell us? When aggressive buyers are hitting the ask and price doesn't move up, or aggressive sellers are hitting the bid and price doesn't move down, what is that saying? Essentially what that's saying is it's saying that someone is there absorbing all that pressure without letting price move. And this can indicate liquidity is being provided, potentially to accumulate or distribute large positions. It could be used to identify trap zones or reversals or potential breakout setups before the actual move. So when it comes to our setup, what exactly are we looking for? Well, there's a few different things that we're looking for, and I'll kind of go through them one by one. So the first thing, of course, is we want to be paying attention to a key level. If you're seeing absorption happen in the middle of nowhere, it doesn't mean much, right? We need to find an area or a level where we are anticipating a potential rejection or that absorption to happen. We're going to go ahead and we're going to monitor that price action and how it reacts to the level as it approaches or tests the level. Then we look for either aggressive buyers or sellers attempting to push through that level, but failing and indicating a potential absorption. And we do this by using something called the point of control, or the POC. And if you don't know what the point of control is, or POC, in this case we're using it for a candle. So it's the area of the candle that had the most volume traded, and we use it to identify where the highest volume occurred within that specific candle. Another thing we want to watch for is we want to watch for the delta to flip, to either go from red to green or green to red, depending on if we're looking for a long or a short. Then what we do is we enter the trade, but before we enter the trade, we wait for a pullback to the previous candle's point of control, and we're going to place the stop right on the other side of that absorption zone. And by doing so, it can end up giving us some pretty good risk to reward setups. So now I want to give you an example and show you what this actually looks like. Here we have an illustration that I created, and we have a key level here. We'll just call this a resistance, and we have bullish candles approaching this area, and then we are rejecting off of this area. As you can see, the blue candles are the bullish ones, the red candles are the bearish ones. And this little black box that is inside the candles, that is the point of control. And something to mention, which I'll touch on a little bit later, is that the point of control is only on one side of the candle. It's either on the bid or the ask. And that holds a lot of significance that we're going to go over, but you need to be paying attention to that. So as price reaches this level, buyers are aggressively hitting the ask. The most amount of volume is here on the ask. It means that buyers are aggressively market buying, and it's causing the POC to be on the ask. As they reach the key area, they are trying to break through. You have all this volume up here, and buyers are trying to break through this area, but they're failing to do so. If you look at the point of control inside the candles, they are sitting in the wick, right? And that's important to note. More often than not, when you're looking at POC in candles, it is typically within the body of the candle. That is what you're going to see 80% of the time. We are looking for when the point of control is above or below the body of the candle, when the candle closes. It's very important that you wait for the candle to close, because these point of controls can change anytime the candle is forming. So you need to wait for it to close. So this tells us that most of the volume is happening at the highs, but price is not breaking above the key level. So what does this mean? It means that there is a large seller or sellers here that are absorbing all of the buy pressure, and they're taking the other side of those market buy orders, and it's a clear sign of buyer exhaustion and absorption. And once the buyers actually run out of steam, price is going to reverse, and it's going to give us a high probability short setup. And so the way you enter the trade is you wait for this candle to close. Okay, we had a POC at the key area that closed on the ask above the candle body. Then we had another one. Price opened up here, tried to push up, it failed. Most aggressive were buyers. Here's the POC above the body of this candle. Chances are this is a red candle. You would see a delta flip here, and that is where you would place your entry. You don't want to place your entry right at the POC. You want to place it maybe a point before the POC, and then you'll wait for the next candle to come up, retest that POC, and then you will target wherever you're trying to target. But you're going to be putting your stop right above this area, right above the absorption zone. If price reaches and pushes past this zone and pushes past the absorption zone, this trade is invalid. It might work out, but the probability of it actually working out if it breaks past this level now is not very likely. When we're looking for a long setup, we want the POC to be on the bid side. And just as a reminder, the left side is the bid, the right side is the ask. So if it's on the bid side, this shows that aggressive sellers are hitting the bid, they're trying to push price lower, they're failing to push price lower, and if price holds and it doesn't actually drop, then what it's suggesting is that buyers are absorbing all of that sell pressure. So sellers are getting trapped, and it may later fuel the move up as they get stopped out. And it's the complete opposite for a short setup. You want the POC to be on the ask. You don't want it to be on the bid when looking for a short. And if it's on the ask, then this is telling us that buyers are aggressively hitting the ask. They're trying to push price higher, and if price can't break above that level despite the heavy buying pressure, then it probably means that large sellers are sitting right here absorbing all of that buying pressure, and buyers are getting trapped and likely forced to exit or sell, helping fuel the downside move. Now you might be asking me, Thrax, what happens if the POC is on the opposite side? Well, if you're looking for a short and the POC is not on the ask and it's actually on the bid, it means that the buyers aren't the real aggressor and sellers are already in control. Or if you're looking at a long and instead of the POC being on the bid, it is on the ask, it means that buyers are the aggressor. If the POC is on the ask, then buyers are the aggressor, and it might not even be absorption. So the bottom line is absorption is one side is aggressively attacking, but it's failing. So you need to see aggression and you need to see failure, and that's what creates the trap. The POC location, it's helping confirm who is actually trapped. Is it the buyers or is it the sellers? And where the smart money might be actually stepping in. So now that we have a better understanding of what we're looking for, and we've looked at an example that I've drawn on a whiteboard, let's go take a look at the charts and let's see some actual examples of where this works out, and let's take a look at where it doesn't work out. All right, so here we are on the charts. We are currently on the 5-minute time frame, and I want to show you guys what this actually looks like when we are looking at it in real time, right? So right now, we marked out a fair value gap right here. One of my favorite things to look for absorption in is not only the previous day highs or lows or, you know, other key areas, but I look for it in fair value gaps. Now, it might be a higher time frame fair value gap. It might be a 5-minute fair value gap. It really just depends on what I'm looking for and what time I'm trading. For this example, we've marked out a 5-minute fair value gap here. So this is going to be our area of interest. So we're going to be looking for price to come down into this fair value gap, and we want to see how price reacts. If price shows us that absorption signal, we're going to enter that trade as long as the criteria matches, and then we'll target a minimum of a 1 to 2 risk to reward. So as we enter into this fair value gap, we want to be looking for the POC to be in the wick below the close of the candle, but we also want to make sure the POC is on the bid or the left side of the candle, because we are looking for sellers to get absorbed, meaning a buyer or buyers are sitting within this area and they are going to be absorbing all of the selling pressure. And we identify that by the POC being on the correct side. We also want to come down here and pay attention to the delta. We want to make sure that when we are looking for our trade, we are looking for a delta flip, meaning that delta goes from being in the negative and it goes to being in the positive, and it has a big difference in change. So right here, what do we see? We see the buyers are aggressively trying to push and sellers are absorbing the buying pressure. You might ask me, well, why don't we take a trade for the shorts? Well, it's because we are watching this as our key area. We do not want to short into our area of interest that we are watching. We are looking for the sellers to get absorbed by the buyers somewhere in this area. Now, if price breaks below this fair value gap and it inverses this fair value gap on the 5-minute, then our trade setup is invalid and we're just not going to take it. But we are looking for this to happen, but we are looking for the candle to close. Okay, so the candle just closed. This is a perfect example of what we are looking for. Price comes down into this fair value gap and it has a long wick here, small body and a long wick. Sellers try to push down, or the most volume for the sellers was here below the close of the candle, meaning that sellers try to push down aggressively. Buyers absorbed all of that selling pressure here in our key area, and now we need to watch for the delta. Now, what we realistically want to see is you could, after this candle closes, you could just enter in a limit order, let's just say right here at this level, right above the POC, but we want to see the delta change. So it's a little bit less likely, the probabilities are a little bit less likely if you don't see a delta flip. Right now on this 5-minute candle that just closed, the delta is minus 915. If you wanted to be aggressive and take a position, then yes, you technically could, you know, enter in right here, set your limit order, wait for price to come down, retest the POC of this candle, and look for the reversal. It would be a pretty aggressive entry, but it can be done. What we want to see is we want to see price create a green candle, or in this case a blue candle, have a flip in delta, see that confirmation that delta is flipping, buyers are now taking control, and then we would place our limit order in this area. So let's see what happens. So now as we're looking at this candle, we went from a red candle that had a negative delta. We witnessed the POC close below the body of the candle. We are in our key area. The next candle closed green. What we want to look at now is the delta for this candle went from a minus 915 to a positive 156. Now that's not a massive change. Sometimes you'll see the changes be way higher, but for Asia session, that is a pretty big change in delta from one candle to another. So what we're going to be looking for is we are going to be placing our limit order maybe 1 or 2 points above the POC of the candle. So we'll place it right here. And then we are going to be placing our stop right below this candle. And we are going to be going for a 1 to 2 risk to reward. So let's see if price wants to tag us into this position. So price is pushing up. Don't worry, we don't want to chase this. We want to wait for price to come down and retest this POC. If price wants to move without us, that is fine, but we want to see it come back. We need to be patient. And this is something I struggle with, but you know, you guys might be better at it than I am. So now we just got tagged into our trade. We paused it. Price came down. It retested the POC of the candle that we were watching, the one that had the seller absorption on it. So we want to look for a minimum of a 1-2 risk reward. Now, of course, you can place your TP to take out recent highs, or you can target whatever you're trying to target. But the main point is that you want to place your stop loss below the candle. If price comes down and it breaks past this candle that we were watching for the entry, this entire setup is invalid. This is no longer going to be a valid setup. So we are putting our stop loss right below the candle that we were watching, and we are targeting a minimum of a 1-2 risk reward. You can target, these highs, let's say, if you really wanted to, or whatever else you're looking for, another fair value gap, whatever. But just to keep it simple, we are only going to target a 1-2 on all of these examples so that you can get a better idea. So let's watch price play out and let's see if this trade works out. Now, something to note is this POC did close above the body of this candle, but don't worry, it was on the bid side and this is a blue candle. We're not really too concerned with this. If this was showing that once we entered this fair value gap that there was buyer absorption, meaning that the POC was on the right side or the ask side, then this would probably tell us that we might need to move our stop to break even to minimize any risk. But because it's on the wrong side, we do not care about it. And this right here is another sign of sellers getting absorbed by the buyers. So this is giving us more confirmation to hold this trade to our full TP here. And if you really wanted to, you could have added in right here. Price printed that seller absorption, price came down, retested the POC, and now it's pushing back up. So this is something we want to watch for right here. We see that now buyers are getting absorbed a little bit in this fair value gap that was on the way down. So we want to make sure that we can minimize risk. If you want to, you can move your stop to break even, or you can move it right below this candle where the sellers were getting absorbed. And then we can wait to see if price wants to hit our full TP. All right, so price hit our full TP, and that was a successful 1-2 risk reward. So just a quick recap on this example, what did we look for? We looked for our key area of interest that we were looking for. In this case, it was a 5-minute fair value gap. We saw price come down on this 5-minute candle. It created a long wick down. When this candle closed, the POC was below the body of this candle. So then once we had a green candle print and it closed, we noticed that delta changed from red to green, or in this case, red to blue. Then we end up placing our limit order for a buy position or a long right above the POC. Comes in, it tags us in, and then it goes up. We don't care about this in this fair value gap because this is something that is on the wrong side. The POC is on the wrong side in this case. So we don't actually care about that. Price came down. It printed the same thing again. So this is giving us even more confirmation that sellers are getting absorbed. And at this point, once we saw price come up here and print that buyers were getting absorbed here in this fair value gap, then we can manage our risk a little bit. You can move it to break even. You can move up your stop loss to be right below this candle that printed the seller absorption, and then we just hold our trade. So this is one example of it working out. Now, obviously, I cherry picked this one just to show you what it looks like when it does work out. There are times where you're going against the higher time frame analysis, or there's obviously times where this doesn't work out. Okay, but this is essentially what you're looking for. All right, so now we are looking at our second example. This time we are going to be on our 15-minute chart. And for this example, our area of interest, or our area we're going to be watching for, are these equal highs that was acting as a resistance, and we eventually broke through. And we are looking to see if price comes down and respects this, and if we can find some absorption here on the 15-minute. So let's take a look at what happened right here. We paused it. This 15-minute candle closed. Price came down to where we marked our area of interest that we were watching, which were these equal highs or resistance level that we ended up breaking through. We're seeing if price now wants to respect this area. Price comes down. Sellers try and push past this area, but they can't. They fail. There's a buyer here, or buyers, that are absorbing all of that selling pressure. So now we have a 15-minute candle that came down. The POC, when this candle closed, is below the body of the candle. And not only that, but we went from a negative 2,000 contracts on MNQ for the delta to a positive 2,000 contracts. So in the previous example, we were waiting for that delta confirmation with the candle following the absorption candle, but because in this example there was already a delta flip here and price came down, and in the absorption candle it has now caused the delta flip, we can go ahead and place our buy limit right here. If price wants to come down and tag us into this trade, we are going to place a stop loss right below the absorption candle, and we can target these highs up here, or London highs, which this is technically would be London highs at 5:30 a.m. Pacific Standard Time. Price comes down and it breaks past this candle, our trade is no longer valid and we should not be in it anymore. So we are going to see if price wants to tag us in, and we are going to see what happens here. Okay, so we are tagged into this trade now. It hit our limit order. We are now in a long position. We are going to set our stop loss right below the absorption candle. And in this case, we want to target at least a 1 to 2 risk to reward, but because the 1 to 2 risk to reward realistically would only be for about 25 points or so, and it would be right here, we can just target London highs. Let's say you thought we were going to take out London highs at market open. We're going to see what happens now with price. Keep in mind, if price in this candle ends up coming below and breaking past this bottom of our absorption candle, this setup is no longer valid, so there's no reason that we should be in it. So it allows us to have a pretty tight stop loss, and we can target all the way up here. So we're risking $28 to make $148 with 1 micro. That's a pretty good risk to reward if you ask me. So let's see what happens. And of course, while this is playing out, if you're looking on lower time frames and you're also seeing absorption happening somewhere in this 15-minute candle or this 15-minute candle, you can manage your risk accordingly. You can move your stop loss, you can trail your stop loss, however you like to manage your risk, whether it's scaling out contracts or adding some in, taking some out. You can do it however you want to do it. I mean, really, this is just an entry model for absorption that you can use with whatever strategy you're actually using. Okay, well, I was going to say we could move our stop to break even, but there was no need to. So we ended up hitting our full TP here. For this, all of the criteria here matched what we were looking for. We had our key area that we were watching for. In this case, it was this resistance level that we ended up breaking through. We were looking for price to find some type of support off of it. Price came down. Sellers tried to push back below this level. They failed to do so, and our absorption candle printed right here. And not only that, but we had a delta flip from negative 2,000 contracts to positive 2,000 contracts. So once this 15-minute candle opened up, we thought we could place our buy limit here with a very tight stop loss right below it on the 15-minute time frame and targeting London highs. It ended up working out. All the criteria hit, and this would have resulted in a successful trade. I know that in the examples that I showed you, obviously I picked them for a reason. I knew they would work out. But the point is that this is an entry model that you can be using for your own trading. It's not going to work out every single time. There is still an element of discretion that needs to be used when you are using this type of entry model. But something to notice is that if you backtest this strategy or this entry model, you're going to find that it happens all the time throughout the day. I mean, we're now currently looking at the 3-minute time frame. That 15-minute entry that we took with our key level right here, there was also a 3-minute candle that printed that did the exact same thing. You could have done the exact same model or entry on the 3-minute. There's up here, we are noticing absorption, price comes down. Up here, we're noticing absorption of the buyers, price comes down. Down here, there's absorption of the sellers, price comes back up. And it happens throughout the day, but it's important that you only use this at key areas that you use for your own strategy. Otherwise, the probability of it actually working out is going to totally plummet. And you want to make sure that you confirm the absorption by recognizing a delta flip. And the reason why is because with a delta flip, you're essentially watching the momentum change hands. You're watching the control be taken away from the sellers and moving over into the buyers, and now the buyers have control, or vice versa. And so you can ignore the delta flip and you can enter off of just an absorption candle, but it's going to be less probability that it's actually going to end up working out in your favor. But Nonetheless, this is one of my favorite setups when it comes to actually trading with my footprint charts. I use this with my actual trading strategy though. So I'm not just entering trades only because I'm seeing absorption happen, or I'm just only watching the footprint chart. I'm watching my trading view. I'm watching for my normal strategy. I am watching for my key levels that I marked out pre-market before we even started trading. But I'm watching for when buyers get absorbed or sellers get absorbed at those key areas, who's getting trapped. And then if it is at an area that I was watching for to begin with, then yes, I am going to take the trade. And it doesn't work out every single time, but what I found out is that it works out enough for me to like to use this entry model. So go ahead and back test it. If one thing also I wanted to mention is with this platform, ATOS, I don't think I've seen any other platform that has replay capabilities like this. I mean, ATOS allows you to actually replay in real time. You can go back, you can literally watch it at 1-to-1 speed. You can watch the orders come in, the market. You can also use ATOS to look at the DOM and see where orders were resting. They allow that option too in their replay, and it's by far the best replay that I've ever used. It's way better than the TradingView replay, and just the replay alone is very valuable when it comes to wanting to backtest. I mean, you don't even have to use this to backtest footprint. If you wanted to use your normal strategy and just backtest it real time and not have choppy candle price action like how TradingView has, you can literally just use ATOS for that. And if you're interested in it, they do have a 14-day free trial. You can claim that by clicking the link below in my description, and you can go ahead and use it. And let me know what you guys think about ATOS. Let me know what you think about the absorption strategy, whether or not you might put it into your trading strategy or not. And then in the next video, we'll be talking about another strategy that I like to use when it comes to reversals by looking at footprint charts. So until then, I'll catch you guys next time. Peace.